Welcome to Policy on Demand. I'm Pat Brown. Last week, the OECD released administrative guidance, which includes details on the long-anticipated side-by-side agreement. The guidance included a safe harbor to exempt U.S. multinationals from the Pillar 2 IIR and UTPR taxing mechanisms, which is a significant development for many companies. That being said, the guidance was just released, so U.S. companies are still working through what it means for them, including the financial reporting implications. Joining me today to discuss just that, Eric Suplee, PwC's Washington National Tax Accounting Services leader, and Keith Rymer from our National Professional Services Group. Welcome, Eric and Keith.
Good morning, Pat.
Hey, Pat.
So you guys are actual accountants, right?
We are.
So I feel like, this is like, as opposed to asking medical advice from my brother-in-law, I can actually talk to the real experts with respect to something where there's expertise required. So I'm excited to do that. Keith, I want to start with you, if we could. Companies are just starting their 2025 reporting cycle. So what does the administrative guidance that was just released mean for them?
I'd start by saying that the side-by-side agreement will apply on a prospective basis. So the 2024 and 2025 Pillar 2 reporting implications, obligations have not changed for companies. That means for calendar year companies, they will still need to perform the Pillar 2 safe harbor and full globe ETR computations for the 2025 financial reporting period. And so while there is no impact to the 2025 numbers, companies may want to consider MD&A disclosure for year end in their 10K if they do expect a side-by-side agreement to have a significant impact in future reporting periods and in future amounts.
Yep.
For calendar year companies that are looking at Q1 of 2026, the financial reporting impacts will depend on what is enacted into law as of the Q1 reporting date. ASC 740 requires the income tax provision to be determined based on the enacted law. And the OECD administrative guidance that was released is generally not considered law. Most jurisdictions will need to adopt the guidance into their own local legislation, since very few countries automatically adopt OECD guidance into law in their local territories upon issuance. The other important development we're watching is that there was an EU information notice released on January 12th, so just earlier this week. While that incorporates the OECD administrative guidance into the EU directive, in the past, EU member states have still concluded that they need to amend their local tax laws to incorporate that administrative guidance. So this will be something we need to continue to monitor for developments over the coming weeks and months. I think the overall key theme for companies is that all companies will need to closely monitor legislative developments across the globe, not just 2026, but potentially into later years as countries adopt the OECD administrative guidance into their local legislation, into their local laws, to ensure that companies are accounting for those changes in laws in the appropriate financial statement period.
So thanks, Keith. And I would just kind of follow up on that. You said a lot with that response, just to underscore a couple of points, because they keep coming up in conversations with clients. One is, did the package that was just released have any impact with respect to 2024 or 2025? Specifically, Keith, you focused on 2025. And the answer is generally no. Yep. And then with respect to 2026, this key point about the fact that even though we now have agreed guidance at the inclusive framework level, this still does, generally speaking, have to be implemented in the laws at the jurisdictional level for each country to take effect from the standpoint of financial reporting. So just to underscore those points. Yep. Okay. Yep. So it does sound like we're going to have to keep monitoring local legislation. But with that, what else would you say companies should be doing to prepare for Q1 reporting?
I'd say the most important consideration for companies is ensuring they're ready for Q1 computations as it relates to their interim tax provisions for Q1. With the UTP safe harbor for U.S. multinationals having expired as of the end of 2025, the UTPR will be enforced for 2026 based on many countries' enacted law, and this will be the first time that U.S. multinationals will need to assess whether a Pillar 2 top-up tax is required with respect to their U.S. operations.
Right.
So these are calculations that generally have not been needed in the past. So this will be the first time for many U.S. multinationals to have to prepare these calculations. And while it's still early to know what legislative actions countries could take between now and the end of Q1, it takes just one country with a UTPR in force to trigger that computational requirements of the UTPR with respect to those U.S. operations. Therefore, companies will need to continue to determine and monitor if there is a top-up tax obligation to include in their Q1 interim income tax provision. And that determination is going to be based on enacted law as of the Q1 reporting date. So monitoring developments, monitoring legislative actions is going to be critical for companies as they're looking at the Q1 reporting date. And as we all know, Pillar 2 calculations can be data intensive and complex, since each country's requirements can vary based on local law. So getting a baseline estimate, in particular related to those U.S. operations, as early in the reporting process as possible, will be one of the key action items in the near term for companies as they're looking out to the Q1 financial statements.
Yeah, thanks, Keith. And just to kind of double down on that point, so Q1 2026 is going to be upon us before we know it, even though
Absolutely.
I know a lot of calendar year companies are right now in the throes of closing 2025. I would assess, this is me saying, not you, Keith, but I would assess that it's probably unlikely that every single jurisdiction that has the UTPR will have made the law changes necessary to put this package of guidance into their laws by the end of Q1. And so I think this issue you've talked about is when you get to Q1, how do you think about the UTPR, particularly with respect to U.S. income, because we had the safe harbor that was in place for 2025. So that's going to be a change. Now, I will note there is some helpful discussion in the OECD guidance package that was just released that talks about the fact that there's a footnote in the guidance that talks about the fact that as countries do bring this new package of guidance online, it doesn't mean they're not applying the UTPR. It means the UTPR top-up tax amount for that jurisdiction will be deemed to be zero. And so what that essentially means is if you have a country that hasn't adopted the guidance by the end of Q1, you will still have to do the UTPR computation, but you shouldn't face into a situation where that jurisdiction that hasn't yet adopted the guidance is somehow collecting all of the potential UTPR that would otherwise be due. So all in all, a very complicated situation, a very fluid situation that we're going to have to continue to monitor. So Keith, thanks a lot for that. Eric, I want to now turn to you. We have been talking a lot over the last week and a half, indeed, over the last several months, about Pillar 2. That's been a significant challenge for companies, no doubt. But that's not the only thing companies have had to worry about. So another issue that has taken center stage for 2025 and the year-end reporting cycle is the new income tax disclosure accounting standard update. Easy for me to say. As companies work through their year-end disclosure process, what should be top of mind with this new standard? I have had a ton of conversations about this issue, and I'm glad we've got an expert here to break it down.
Well, thank you, Pat. To level set, the ASU focuses on transparency, and it requires companies to present a more detailed, effective tax rate reconciliation and additional breakout of cash taxes paid. For the vast majority of public business entities, the 2025 10K will be the first time that they will be reflecting the new rules. At this stage, most companies have worked through the initial modeling of the new requirements, but maybe here are three areas that companies should be paying close attention to. One is the method of adoption. This will be a key decision companies will need to make in terms of how they will adopt the ASU. And they can do so either prospectively or retrospectively. We've been monitoring disclosures throughout the past year and have had discussions with companies regarding their intended method of adoption. At this point, prospective versus retrospective seems relatively mixed, and time will tell if there's a trend one way or the other. For companies that have not finalized their decision, that should be the top priority. And if a company decides to adopt retrospectively, that does require a fair amount of work to gather and analyze all the prior year data in order to meet the disaggregation requirements and to ensure the disclosures are consistent across all periods presented. Next up is materiality. The standard introduces 8 required categories in the requirement to further disaggregate certain categories by using a 5% quantitative threshold. As a result, there have been a fair number of questions regarding whether or not certain items need to be disclosed on the basis of materiality. The ASU does not provide specific guidance on materiality due to the fact that there is existing materiality guidance in Topic 105. Topic 105 applies to all of US GAAP, including income tax disclosures. That being said, the determination of how companies apply that guidance will require judgment. So it will be important for any decisions regarding materiality that those are made in close coordination with the broader accounting and reporting function. The last area I'll touch on is netting of really rate reconciling items. As a general rule, the ASU requires all items to be presented on a gross basis by nature and jurisdiction. However, there are two exceptions that would permit a company to net certain items. One exception relates to cross-border tax effects, same income, same jurisdiction, same period. For the US, the typical example is where there is US taxation on foreign earnings, and a company can net the related credit against the income. So for example, a US parent company can net their GILTI FTCs with their GILTI income. The other exception is for current year unrecognized tax benefits, which can be netted against the item to which they relate. Beyond those two exceptions, netting is not permitted. And that is a fundamental shift from how companies may have presented certain items historically. For example, foreign jurisdictional activity that was similar by nature, but related to differing jurisdictions, may have been netted into one line item in the past. That's just one example, and there could be other items that would have had a different presentation as well. So those are just three things to be thinking about, but there certainly are a lot of areas of complexity or challenge that companies need to think through as they get into the details and prepare their disclosures.
So Eric, there's a lot to think about there, and fair to say it's going to take companies more than a few minutes to work their way through it, I think. But before we wrap up, I do want to ask one additional question. So what action would you recommend companies take right now?
Right now, I would say the immediate focus should be on finalizing the decision points that need to be made. I previously mentioned finalizing the intended method of adoption,
Right.
but there are other policy choices that need to be made. The one that I haven't hit on is with respect to unrecognized tax benefits. And that's the category where a company can choose to either present changes in prior year positions on a worldwide aggregate basis, which could be the only category that would allow such aggregation, or a company can present that category on a jurisdictional basis. All of those policies can result in vastly different presentations and may impact how a company gathers and analyzes its data. The last point here is to have tax not operate in a vacuum, have tax make sure that they're meeting with all of the relevant stakeholders and that the company feels really good about what its disclosures will look like, not just for this year, but going forward.
So Eric, thanks for those insights. And Eric and Keith, thank you both for joining us today. Again, proving out when you have accounting questions, talk to an accountant.
Thanks, Pat.
Thank you, Pat.
So we'll be interested in hearing about how the year-end process goes for companies and the likely continuing Pillar 2 discussions as we watch for further developments. And for our viewers, you can find the latest Policy on Demand episodes in the description of this episode and on our website. We appreciate you spending this time with us. Take care.